If you want to retire young, you don't need to save more money or work harder. All you need is one simple way to turn your cash into a weekly income stream while keeping the balance intact. I'm going to show you exactly how I do this with the stock market in this video. Let's get into it. So an overview of the process is the first thing I do is I find high quality stocks and use AI to validate them. So I just search on Motley Fool and Yahoo Finance, and I find companies that I really like and I really want to own. And then I use simple prompts to make sure that they're good investments. And then I sell an option on them. And every time I do this, I make about a 1% premium on it. And this is just income hitting your bank account every single week based on this. I then wait a week because my options contracts are generally about a week long. And then the stock either sells at a profit or I keep it, right? And I repeat this process. And this is how I'm generating income every single week with my stocks. So if you're new to options, an option is basically just a financial contract, and it gives an investor the right to buy or sell a stock at an agreed upon price and date. So basically, it's a little contract that I have with someone else, and they are the simplest way to think about it is they're renting my stock. I own the stocks, and then they are renting it from me for a period of time. They pay me 1% generally for the right to do this. And then if the stock price reaches a certain price, it sells. If it stays below, I keep the money. But I'll talk a little bit about that in a minute. So a lot of people have really negative connotations around options. They seem to think that it's the most risky thing, but it doesn't have to be. And I'm going to show you exactly how I manage risk in a second. So I think most people end up, when they're a little bit younger, maybe 18, 19, they hear about options trading and they start to buy options. And this is speculative. Buying options is completely speculative. But here we're selling. We're selling the option. We own the stocks and we're effectively renting them out. So we're getting paid every single week to own the stocks. So let's talk about how we manage risk, because this is exactly what most people want to know. So firstly, we set a limit on how high the stock price can go before the other party can buy the stocks. So let's use an example, right? Let's say we bought a stock for $100 and we set a limit of 125 in 7 days. So we sell an option, right? A 7-day option. And we say, if it reaches 125, you can buy it. So now we've got only 3 scenarios, right? Scenario 1 is the stock price reaches the limit. So the stock climbs, hits $125 in 7 days from now. What happens is we get the money from the person buying the contract, which is usually 1 to 2%. This is money just in our pocket, no matter what happens. And then we make money on the sale. So I bought it at $100 and we sold it for 125. So it's effectively a guaranteed, you got income coming in over here, and then you've got a guaranteed profit on the sale because we structured it that way. And then we just repeat, right? We buy the stocks and we do it all again to make more money. Scenario 2 is the stock price doesn't reach the limit. Let's say it goes from 100 to 110. In this case, all we do is we keep the income, the premium that the person bought for the contract. So it's 1 to 2%. The contract is just void and we keep the stocks. And then we just rent them out, the stocks out again next week, and we make the money. So every single week, we're just cycling this. And then scenario 3 is the stock price drops. Okay, so let's say it goes from 100 to 80. And now I just want to give you an important caveat. We only lose money if we sell the shares for less than $100. So our cost price was 100. We only lose money if the shares actually sell. Okay. So if it drops a little bit, let's say like 100 to 98, we literally just do it again. Just rent it out again, and you just make money anyway, and it climbs up again. This happens a lot. If it drops really low, like say for example, drops to like 60, all we do is instead of 7-day contracts, option contracts, we do 14 days or 30 days, something like that. We extend the term. So the price is set at a cost price or better, okay? So we're always guaranteed to make money if we don't sell for less than 100. So all we do is we set our price for, let's say, like 105 or 110, and we lengthen the time frame. You can also raise the limit price. So basically, you just say, okay, it's at 80 now. We go 100 on the dot, or 110, and you collect less than 1 to 2%. Or if you're nervous, you just wait. You wait a little bit and you let it climb again because you still own the stocks. But either way, you're not losing money, right? In no instance are you losing money. So let's go to the results. So this is historically what I've done. In good markets, 5 to 9% per month. In average markets, 4 to 5. In bad markets, 2 to 4. So with a balance of 100,000, you could be making $2,000 to $9,000 per month in income consistently. So let's jump quickly to my little compounding thing. So basically, we say normally 2 to 5%. So if you set this at 5% and you put in 100,000 balance, you're making about 5 a month, right? And I've seen this ring true. Historically, my returns have been about 5% every month. And you can see over here, if you keep doing it for a year, suddenly it's 12,000 because it's growing so quickly at this rate, right? Year 100 becomes 240,000. So if we're more frugal and we say kind of 3%, which is pretty frugal, again, August to August, you've added 2,000 to this. So this is the process that I do. This is exactly how it works. If you want a one-page overview of exactly how this process works, then comment stock below and I'll send you the PDF document. If you want to see a live demonstration of exactly how this works, watch the next video. I'll show you and make money live on the stock market. And finally, if you found this valuable, please like and subscribe. It really helps me, and I'll see you on the next one. Thanks.